The collapse has begun. As I'm speaking, China is dumping billions upon billions of US dollars by the hour, abandoning the world's reserve currency and triggering a rapid decline. Just recently, Biden demanded over $100 billion more from American taxpayers to fund his out-of-control spending. But other nations no longer trust US leadership. The debt has exploded over $33 trillion under both parties' watch. The tight grip of American dominance on the global stage is loosening. And if it doesn't act now, the consequences will be catastrophic for both the US and the world. In this video, we'll show you the alarming signs that the US financial system is starting to crack. Things are moving fast, so you won't want to miss our time-sensitive analysis and forecasts. Click subscribe below and turn on the notifications so you get notified as soon as our findings are released. The US bond market is exploding. The so-called safest government bonds that were supposed to be as stable as a rock have been collapsing at a breakneck pace for months, sending investors running for the hills. The towering $33 trillion mountain of debt has investors questioning if Uncle Sam will ever be able to repay anything at all. To fuel its spending on stimulus, roads, healthcare for all, and defenses against all enemies, foreign and domestic, Washington has been borrowing cash at a rate never before seen in history. But this debt-fueled spending spree has caused a tectonic shift in the bond market that would make even P.T. Barnum blush. The flood of new bonds has drowned the demand, sending prices plummeting into the depths and interest rates rocketing into the sky. In the worst bond market implosion to rock the globe in over 100 years, the key 10-year Treasury yield that sets the pace for the world has exploded from a sleepy 1.74% in March to a white-knuckle 3.21% now, rising a mind-boggling 147 basis points in just 7 short months. And the long-term 30-year yield, which predicts future inflation and growth, has also shot skyward from 2.41% to a blistering 4.01% over the same volatile period. Bond investors have suffered substantial losses as a result of this yield spike. According to Bloomberg, the Bloomberg Barclays U.S. Treasury Index, which tracks the performance of U.S. government bonds, has lost 9.6% of its value since the start of 2023. This is the worst performance since 1980, when inflation was rampant and interest rates were sky-high. The total market value of U.S. Treasuries has fallen by over $1 trillion since March of 2023. So what's causing this bond market meltdown? One of the factors contributing to the bond market meltdown is the Federal Reserve's pause in rate hikes. The Fed is the central bank of the U.S., and it controls the short-term interest rates that influence the economy. The Fed has kept its key rate near zero since March of 2020, when the COVID-19 pandemic hit. This means that bonds, which are essentially loans to governments and corporations, have been yielding very low returns. However, in recent months, the Fed has begun to raise interest rates to combat inflation. This has led to a rise in bond yields, as investors now demand higher returns to compensate for the increased risk of inflation. As a result, bond prices have fallen, leading to the bond market meltdown. It's worth noting that the Fed pause in rate hikes is not the only factor contributing to the bond market meltdown. Other factors, such as inflation, rising yields, and a general sense of risk aversion among investors, are also playing a role. Another reason for the bond market collapse is the rising inflation pressure in the U.S. economy. Inflation is the general increase in prices of goods and services over time. Inflation erodes the purchasing power of money and reduces the real value of fixed-income investments like bonds. Higher inflation means higher interest rates, as lenders demand more compensation for lending money. The Fed and the Biden administration have argued that inflation is transitory, meaning that it'll subside once the economy returns to normal and the supply-demand imbalances are resolved. However, many bond investors are skeptical of this view. One of the most alarming developments in the bond market is China's decision to reduce its holdings of U.S. Treasury bonds. China is the largest foreign creditor of the U.S., owing about $800 billion worth of U.S. Treasury bonds as of July 2023. China's massive accumulation of U.S. bonds over the past 2 decades has been part of its strategy to keep its currency, the yuan, artificially low against the dollar. By buying U.S. bonds, China has increased the demand for dollars and lowered their value relative to the yuan. This has made Chinese exports cheaper and more competitive in global markets. However, China's appetite for U.S. bonds has been waning in recent years. China's disinvestment in U.S. bonds is driven by multiple factors, including the declining value of bonds. As bond yields rise and bond prices fall, China risks losing money on its bond portfolio. China also faces the risk of currency depreciation, as a stronger dollar reduces the value of its dollar-denominated assets. The deteriorating U.S.-China relations, the trade war, the tech war, the human rights issues, and the geopolitical tensions between the U.S. and China have eroded trust and cooperation between the two countries. China's disinvestment from U.S. bonds has been evident in the data. According to the Treasury International Capital System, which tracks cross-border flows of financial assets, China's holdings of U.S. Treasury securities fell by $113 billion from August 2020 to August 2023. This is a significant drop of 9.3% in just 2 years. China's share of total foreign holdings of U.S. Treasuries also declined from 15.4% to 13.6% over the same period. The U.S. bond market is not only facing a supply-demand imbalance, but also a changing landscape of bond buyers. Traditionally, the main buyers of U.S. Treasury bonds have been commercial banks and the Federal Reserve. Commercial banks buy bonds to meet their regulatory requirements and to manage their liquidity and interest rate risk. The Federal Reserve buys bonds to implement its monetary policy and to influence the economy. However, both commercial banks and the Fed have been reducing their holdings of U.S. Treasury bonds in recent months. According to the TIC data, commercial banks' holdings of U.S. Treasuries fell by $156 billion from August 2020 to August 2023. This is a drop of 12.7% in just 2 years. Commercial banks' share of total U.S. Treasury debt also declined from 13.9% to 11.9% over the same period. One of the reasons for this decline is that commercial banks have been facing lower demand for loans from businesses and consumers due to the pandemic and the economic slowdown. This has reduced their need for bonds as a source of funding and as a hedge against interest rate risk. Another reason is that commercial banks have been facing higher capital requirements and stricter regulations from the authorities, which have limited their ability and willingness to buy more bonds. The Fed has also been scaling back its bond purchases as part of its tapering plan. The Fed announced in September 2023 that it'll reduce its monthly bond buying by $15 billion starting from October 2023, until it reaches zero by mid-2024. The Fed's tapering decision reflects its confidence in the economic recovery and its concern about inflation. The Fed's tapering plan also signals its intention to eventually raise its key rate once the conditions are met. The U.S. bond market is also facing another challenge. President Biden's request for an additional $100 billion in funding for various purposes, including Ukraine, Israel, Taiwan, and border security. This financial demand sparks concerns about how the money will be raised and its potential impact on the economy. President Biden made this request in October 2023, amid escalating tensions and conflicts around the world. The U.S. has been involved in several diplomatic and military disputes with countries such as Russia, China, Iran, North Korea, and Venezuela. The U.S. has also been supporting its allies and partners in regions such as Europe, Asia, and the Middle East. Some of the specific purposes for which President Biden asked for more funding are Ukraine. The U.S. has pledged to provide $60 billion in military aid and economic assistance to Ukraine over the next 5 years, as part of its effort to deter Russian aggression and support Ukrainian sovereignty and democracy. Israel. The U.S. has agreed to increase its annual military aid to Israel from $3.8 billion to $4 billion starting from 2024, as part of its commitment to ensure Israel's security and qualitative military edge in the region. President Biden's request for more funding has faced opposition from both Republicans and Democrats in Congress. Republicans have criticized President Biden for spending too much money on foreign affairs and neglecting domestic issues, such as inflation, unemployment, healthcare, and infrastructure. Democrats have questioned President Biden's foreign policy priorities and goals, especially his involvement in wars and conflicts that have no clear end or exit strategy. The U.S. bond market collapse and surging yields could have dire consequences for the U.S. economy and the global economy. The U.S. Treasury bond is considered to be the safest and most liquid asset in the world. It's also used as the benchmark rate for borrowing costs worldwide. Therefore, any disruption or instability in the U.S. bond market could affect other markets and economies in various ways. Some of the potential consequences are higher borrowing costs, lower asset values, slower economic growth, higher unemployment, higher inflation. As yields continue skyrocketing and foreign investors lose faith in America's fiscal responsibility, the collapse of the global financial system may be imminent. Dark days are ahead as the full impact of this crisis sends the world economy into a tailspin, and ordinary people will pay the heaviest price.